trust that you're eager, that you're ready. I must say, for many of you, if you've made it to day 2, you are survivors. So thank you for coming back and participating and sharing your eagerness with us and carrying forth this conversation as we look to be re-inspired by the African continent. We'll start off with our first speaker for today, a presentation to give us clarity with regard to the overview of the environment regarding global capital and liquidity trends, and most importantly, their impact on sub-Saharan capital markets. Ladies and gentlemen, please warmly welcome back on stage, a familiar face to many of you, Tom Mandi, who's the head of international capital for sub-Saharan Africa at JLL.
Thanks very much for the intro, and thanks very much for coming to day 2. I've got 20 minutes, so I'm going to try and keep this quite light, quite blinded in the lights as well. So I'll try and keep it quite light for you, just to give you an idea of how sub-Saharan Africa sits in a global context, with particular emphasis on global capital flows, the way capital is behaving, looking at cycles, and that sort of thing. I think the first slide, the first point I would make is that, and it's a theme that's come through quite a lot over the last come through quite a lot yesterday, is the extent to which sub-Saharan Africa and EMEA in particular, but also the global economy, are heavily intertwined but slightly decorrelated. We've gone through a very, very extreme economic cycle over the last 5 years or so. Whereas in Europe and globally, it's really not been the case. It's been a very slow, gradual, and if you're in real estate world, very encouraging and positive response to the global economic crisis, underpinned by a very accommodating period of monetary policy. But right now and through 2019, there's been a lot of noise in the market, and there's a slight, one of the points that we try to make is that this decorrelation or this lack of connectivity is shown to the extent to which sub-Saharan Africa is quite is kind of coming to the fore a little bit. When we look at these economist headlines, you can see all the stories. Certainly China, America, late stage in the cycle, this kind of thing is playing heavily on equity markets. All the issues in the UK, all the issues in Hong Kong, heavily politicized, starting to feed through into jitters and nerves in an environment where growth, particularly in Europe, is quite hard to find. In Africa, there's been a strong emphasis on inflows and capital inflows into Africa. It hasn't really happened in the real estate market, but there has been, again, and say, this common phrase, scramble for Africa. Economies like the Russian economy, where they've got excess liquidity generated through oil exports, have been very, very active on this continent. To touch on the themes that we see globally and then contrast them with the themes that we see in sub-Saharan Africa, certainly the European economy, there's a lot of uncertainty. Growth is quite slow. It's quite hard to get more than 2% growth unless you're in emerging Europe, hence why quite a lot of South African capital tends to look at emerging Europe rather than traditional Western European markets. The rate cycle, difficult to call, except we know it's going to be low for longer. Whether it's going to be a new low cycle in the US or it's going to start picking up in 2020 is a matter for debate. ECB also has to keep rates quite low. Inflation is still quite muted. Politics, the UK is a mess. The US is a mess. China is being challenged. Politics is now starting to have something of an influence in the economy, which I'll show you a slide later, which shows that's not always the case. In the real estate market, there are a number of disruptors out there. Flex is huge, probably starting to slow down a little bit just because of a lack of supply. Corporate activity has been extremely strong, so even though economic growth is a little bit stilted in Europe, for example, corporate activity has actually been pretty decent. Big pressures and stresses on the retail market. Industrial logistics, definitely pretty strong. In terms of investment, very late stage in the cycle, a lot of liquidity chasing, not a lot of assets. That's pushed yields down to record lows compared to where we were in the previous cycle. Big funds active, big M&A portfolio acquisitions, turning quite defensive ahead of potential future volatility. So returns now are very challenging. In sub-Saharan Africa, it's actually very different. We're coming out of that down cycle. Economy is starting to pick up selectively. SA is still a challenge. Angola is still a challenge. Nigeria I would say provides a degree of optionality. If Nigeria can get it right, then you've got some degree of upside. Fiscal consolidation to take out volatility in markets is extremely important. Politics, I mean, politics is still, or economics is still too heavily politicized, arguably, in sub-Saharan Africa. Saying that, though, recent economic cycles have been, political cycles have not been quite as destructive as they have been previously. As far as the real estate market is concerned, I'm actually fairly encouraged by rental rates and leasing activity, certainly in West Africa. We are seeing enough evidence to suggest that it has at least bottomed out. There's a very strong correlation between economic growth, take-up, and rents, particularly in an environment where there's not a lot of supply. Supply has pulled back in a lot of the markets we work in, so realistic expectations of rental growth are starting to kick in a little bit. Possibly a little bit more cautiousness amongst global occupiers as concerns Africa, just because of the cyclicality of it. And then in terms of investment, definitely the case that the weaker South Africa is, the harder it is to get rental growth in South Africa, the less the South African economic real estate equation works, and more capital chases yield in Europe. That capital, as we discussed yesterday, not necessarily moving into sub-Saharan Africa. But definitely we can say that we're moving into an early stage cycle. There are opportunities, and capital is chasing that. To make this point about volatility and the way that global real estate markets respond to volatility, this is an economic uncertainty index, which basically skims news flow in broadsheet and tabloid papers. And it quantifies the degree of uncertainty through this chart. So what you can see running through from 1998 through to 2008 was subdued levels of volatility and uncertainty, or uncertainty around economic policy and political policy making. And then from 2009 through to now, huge levels of uncertainty and volatility, particularly in the UK, particularly around the Brexit vote, US debt ceiling, Eurozone crisis. But this period of high levels of high volatility has also been married with extremely low levels or extremely accommodating levels of interest rates and monetary policy, which has fueled a massive boom in global real estate that largely missed sub-Saharan Africa. So to look at the way that capital is flowing, probably quite difficult for you to see the numbers, but there's two important points. One is that capital is increasingly flowing out of Asia. So Asia is a net buyer of real estate in Europe. Through 2019, Chinese dominance has been replaced by Korean dominance, which is by a factor of about 4, actually. So a lot of that is driven by pension fund liquidity, looking for yield and looking for annuity income. The US, also a massive net buyer of assets in Europe and EMEA, and also global funds. To make a point about global funds, liquidity is increasingly global. It's very hard just to have single country strategies. So capital tends to be much more flexible than it has been through previous cycles. Probably not easy numbers for you to see here, but what's behind all that liquidity? There's a fundamental case that there's a far higher allocation to real estate now, and it's an increasing allocation to real estate than there has been at any point in history. So if you can see the numbers, 2013, this is all investment, there was roughly below a 9% allocation to real estate. And that's increasingly sort of moving up to the 11% or so mark. So that's actually, incrementally, that's a very significant source of liquidity. On the margin, the biggest sources of that growth are actually, I mean, it's across geographies, but Asia-Pacific. And again, that plays into this idea of Asia-Pacific, Korean, Chinese, Hong Kong money looking for yield in Europe and in the US where they can find it. Obviously, regulation in China has put a bit of a dampener on that. China, you could argue, in the US now is probably a net seller. So the other point about that is where there is growth in this allocation to real estate, broadly speaking, it's amongst the mega funds, which is the other big trend that you see in global capital is that the bigger the fund, largely the more successful the fund. So Blackstone's record $25.5 billion raise that closed last month is actually not far off where they were before or where the sort of levels that Brookfield are. Huge funds doing huge deals with scale, increasingly in core markets as well, because you have to have size to operate in core markets. And then the other point is if you break down those sources of capital, institutional capital is extremely active, allocating to private equity, to closed-end funds, for example, to my point about Blackstone. So a big allocation from institutional capital. And how does that capital behave? Interestingly, the size of real estate, what is the real estate market, has changed hugely through the course of this cycle. With all this liquidity chasing fewer and fewer assets, bear in mind there hasn't actually been a lot of supply coming online, particularly in Europe through this cycle, because development financing hasn't really been there. Municipal governments have been very cautious to allow booms in regional real estate supply or city real estate supply. So it's harder and harder to find yield. So what we found is that the size of real estate market by asset class has increased hugely. So it's not just your traditional established asset classes like offices and shopping centers and industrial facilities, but increasingly purpose-built student housing, student accommodation, self-storage, data centers are becoming a target for choice by those huge global funds that have been raising, like Brookfield and Blackstone. You know, Blackstone alone, to give you some examples, has just committed 8 billion euros to urban warehousing in Europe. That's huge. Those are kitchens in warehouses in central London. Those are last-minute deliveries, warehouses providing last-minute deliveries in urban centers. So huge, huge commitments. And then again last week, again, Blackstone, with all this liquidity they have, coming from institutions, coming from pension funds, $6 billion to take out Colony Capital's logistics portfolio. So that kind of capital is moving increasingly into this alternative space to find yield. Student housing, I mean, you can pick any, CA Ventures have committed $500 million per annum to Irish and UK student housing. So huge amounts of capital looking for this. And the way that deals are being done is also different. It's not just direct real estate allocation anymore. There's club deals, there's debt, there's any possible way of getting allocation to real estate is increasingly prolific and prevalent. To make the point about where we are in the cycle, I've just looked at direct real estate investment volumes, which is something we track at Jones Lang LaSalle. So how many assets have been bought in our three global geographies, EMEA, America, and Asia Pac. What you can see here, if you look closely, is you can see a very, very late stage in the cycle. So it's sort of plateauing. Investment volumes are kind of plateauing, again, for the reasons we've been talking about, very hard to find product. European volumes have been falling, but interestingly, most of that is driven by the UK. To give you some numbers, roughly just shy of a 50% drop in London investment volumes in the first half of 2019, roughly 160% gain in investments in the Berlin office market in the first half of 2019. So slight discord in Europe, but plateauing, starting to fall. US was falling, but now picked up a little bit in 2018, much to our surprise, fueled by Donald Trump's tax cuts. And then the big net buyer, or the big incremental grower, really is Asia Pacific. So Asia Pacific market's probably not quite as far ahead in the cycle as Europe and the US. If you look at Europe and you break that down and you look at cross-border flows, since cross-border activity is really what's relevant for Sub-Saharan Africa, what's interesting is that roughly 2/3 of transactions that happen in EMEA are either domestic, so between countries or between region, and the remaining third is proper cross-border. So if you look at the 2018 chart on the far right there, I've got 2019 as well, but if you look at 2018 numbers, you can see where the sources of capital. On the bottom, the sort of red bits are European capital, and the gray and black and white bits are cross-border from the US or from Asia Pac or from the Middle East and Africa. What's interesting is that the Middle East and African component that's going into Europe is quite short, it's quite small, but it's grown exponentially from about 2 billion euros in 2009 to about 11 billion euros now. And I'm not even sure in fact, I'm pretty sure this number doesn't even really capture the full extent of Sub-Saharan African capital that's leaving and going into Europe. particularly South African capital. I reckon on about $4 billion of South African capital per annum for the last 4 years has gone into Europe. This is not likely to change unless there's a massive external shock, because the interest rate environment is what underpins it. To make my point about political volatility earlier, and to an extent economic volatility, as long as there's liquidity and as long as interest rate expectations are getting pushed out, it is still a very accommodating environment. The maths work, and this is an interesting chart which looks at yield spreads. So it's the spread between, well, sorry, this is not the yield spread, this is the yield range through the previous cycle and where yields are now. I don't know if I can use a laser. Can you use a laser? It's going to shake a lot. So if we look at Berlin, for example, you can see that little red line. That shows you that during the previous cycle, so through the global financial crisis, yields moved from roughly 4.5 to roughly 5.5. Very, very stable, very, very tight. Currently, Berlin office yields are about 3%. So it's never been more expensive to buy offices in Western Europe. Why? Because there's lots of liquidity looking for lots of stable income where there's not a lot of volatility and it's very predictable income streams. They pay for that. If you go to emerging markets, where you've got a big red line there which shows a big range of yields through the previous financial crisis, you can see that the market is far less willing to pay for that volatility. And that, to an extent, explains why Africa has been, apart from our own economic cycles, is always going to be a bit of a challenge for this global liquidity, because it's hard to predict your income stream. Even Moscow, if you go to Moscow, a city that I lived in for a long time, huge ranges of yields. And even now, yields are still struggling to get back to where they were during the previous economic cycle. So institutional capital loves to pay for yield, but increasingly it's hard to find it, and it's getting pushed up the risk curve, which is why we're seeing increasing interest, I think, in good quality products in sub-Saharan African markets. And then just to break that down a little bit, I was mentioning Berlin just before I finish. This is why the maths works on Berlin, even though you're paying 3%, because your cost of, this is your yield, Berlin yield, this is your 10-year bond, and this is your spread. Compare that to the negative yield that you would get in South Africa, or the sort of flattish yields you would get in sub-Saharan Africa, which require, therefore, rental growth to make the maths work. So even with these numbers, because interest rates are so low, as a proxy for Europe, the maths still very much work. So this global capital is still targeting this. You will still see Koreans doing deals in Germany where they can find them at 3.5%. And to finish it off, just 2 slides on my outlook for sub-Saharan Africa. Broadly speaking, however, even though the cycles are different, and perhaps because the cycles are different, I am actually, I'm very optimistic about sub-Saharan Africa. I think economies are improving. Some markets are doing extremely well. I mean, Ghana, for example, is really in demand. Nigeria, like I said, provides optionality. And actually, Kenya, Rwanda, Ethiopia consistently provide really, really strong levels of growth in a global context. Therefore, where you've got economies improving, you've got supply tightening up, you tend to get improved take-up and you tend to get improved rental rates. Office market, we're seeing plenty of evidence to suggest that rents are now more realistic and starting to improve, particularly in the Nigerian market, particularly in the Nigerian office market, with the right product. Flex office space, it was a good presentation yesterday, is going to be a massive disruptor. I think that ability to shorten leases and provide flexibility is absolutely ideal for Africa. Whether it's the WeWork model or another one, I don't know, I'm not going to predict it, but I don't think we should be surprised to see growth in that area. Retail is a challenge. We've still got inflationary challenges. We've still got consumer disposable income challenges. But we've got good quality product in these markets, particularly Ghana and Nigeria, increasingly in Kenya. So with the right pricing, I think we'll see improvements in occupancy. Finally, industrial, huge fan of industrial. I think the consolidating funds, where they can find that product, will buy it. It's just quite hard because our friends at Africa Logistics Properties and Agility and the others have so much control of the market. Pricing, I don't think yields really, they're not, I don't think they're the best indicator of value, actually, because I don't think they're always done on a commercial basis, and I think where you've got quite a lot of vacancy, a first-year yield is a bit of a shot in the dark. But at the same time, we are seeing evidence of rental growth. And it's rental growth probably that's going to drive down capital values much more than liquidity or yield compression. And capital allocation, I think there is a movement up the risk curve. You don't need a lot of money to move the dial in sub-Saharan Africa. A couple of $100 million moves the dial. It's a shot in the dark in Europe, but it's significant here. And I think one of the points that, to finish, that we saw coming through the discussions, particularly on my panel yesterday, is the extent to which there is global capital, even if it's small and even if it's nascent, looking for good quality products with a strong argument, evidence of rental growth, nice covenants, good, in good markets. There's demand for that, and I find that very encouraging. And that's me. And I'm happy to take questions, but I think probably